All right, let's move to United States dollar against the Swiss. We're expecting, of course, shoulder levels, but we no longer are going to get shoulder levels. Remember, this is resistance 2 on the 30 minutes. And that used to be resistance 1 on the 30 minutes. Let's take it higher now to resistance 3. We have a trigger. This is a trigger 4, definitely a trigger 4. Of course, on the premise that we have an indentation that is lower than indentation 2. We have an indentation that is lower here than indentation 2. Must be a level 4. If this is even indentation 2, this is very close to it, so that must be level 4. So we have the right structure. Okay, so again, this becomes easier to trade, I think, in a way, of course. Our next target was going to be 81.20, 81.50. We are approaching this target now. All right. The fib extensions here, this fib extension is out of level 2 to level 3, will give us, of course, level 5, this level 5 that we are looking at. In an uptrend, if the market is going to be trending higher, level 5 usually takes you to resistance 5. I mean, if this is an uptrend, we go to resistance 5. If this is not really a breakout, if this is a fake breakout, and that's not really likely, then we would do well just to go to 131.8. So we're going to either buy market or wait for a retraction and take this to 131.8, which is 81.30 at this point. Next target, of course, is 81.60. Hedge is 80.50. We just need to hedge below that point. And that point is 80.55. So we just need to have a hedge at 80.50. Market is 81. All right, so we can take the edge to below level 1, which is 80.60, not 80.50. Let's now do the internals. Take it immediately to 5 minutes. Just a moment. All right, so 80.64, market is a buy. We just have to buy market at 81. Market is 81.03. I believe we can get 80.95. We can get 81, 80.97. We'll try to take any of these entries immediately. All right, we're going to have a hedge at 80.65. We're going to 81.60. So we are going to buy market again, 81.05. We're going to 81.30, but it is also possible that we get 81.60. We have here 81.60. In between, 81.55 is also very possible. Again, the market is a buy, 81.03, 81.05. We're going to have a hedge at 80.65. Entry is market again, 81.05. Hedge is 80.65. We're looking at 40 points of risk, quite wide, and we're going to 81.60. We're really going to 81.60. It is possible to go to 82 today because 82 is resistance 5. 81.999 is showing here is, of course, 82, resistance 5. So we can take it to 81.90. I believe we will meet target. All right, if you wish to trade intraday shorts, intraday longs, if you wish to trade an intraday strategy, I think we all know how to do this now, so I will just select The two internal resistances that are showing, subdivide them into internal fibs. So I don't really... we have, of course, positive momentum on the 5 and 15 minutes, so we don't really need momentum. What we need to look at is this, so that we are able to implement strategy. Okay, great. So this is a fib division between resistance. I believe this is resistance 2 and resistance 3. I will always have an entry. If I'm going to trade 1.5 standards, for example, I'll always have the entry at 50%, and I would also always have an entry at half size, and I would also have an entry above the market. So I'll have an entry at 81.10 market, or very close to market. Let's say at 81.07. All right. So my entry at 80.50 takes me gets me entered at 80.97 or 80.95. Let's say at 80.97. I take profit at 81.07. I have 81.04 here. All right, and my entry at that is now engaged, I believe it was at 81.10 or 81.07. Let's say it is even 81.13. At 7 points, take me to 81.20. I'm looking at 81.18. But and I continually recur. So by the time I get to 81.18, I can have another entry at 81.20 immediately. So I have another entry at 81. Take it to 81.30. Again, it's a half size entry. All right, and I raise my buy limit to 50%. So I'll raise this entry to 81.10. Take it to 81.20. This one, 81.10. If it gets filled, take it to 81.20. Of course, you need to have gone to 81.30 before you drop back to 81.10. Or even 81.15, take it to 81.25. All right, the key is to trade between the internal pivot levels. The very internal pivot levels. So right now, if you're breaking out of resistance 2 to resistance 3, you see here resistance 2 and resistance 3, I must focus all my buy limit and my buy stop between resistance 2 and resistance 3. So right now, that entry at 81, the lower entry is usually that entry at 80.95 or 80.97 is not really going to work. My first So my first buy limit entry is 81.10, and my buy stop at this point is 81.15 or 81.16. Market is actually 81.16. My buy stop is market, or my buy stop is 81.15 if the station allows it. Market is 81.19, and I'm having a limit at 81.10. Right. Each entry takes me 10 points higher, or 7 points higher if the case may be. I can now have a buy stop at 81.20. Takes me to 81.27 or 81.30. This is right now 81.20. Takes me to 81.27, this point here, or 81.30. Higher, I take it from 81.30 to 81.37. 81.38 is showing. 81.37, 81.38 is very possible. What about the hedge? So if I'm in at 81.20, I can have a hedge at 81. I'm having the hedge here at 81. This is the first support level 3 that we get to see. It will probably show on the 3 minutes, this indentation here. If we fall that low, we can have a hedge that will take us just 5 points below entry. If this is too close to the market action, if you find this too close to the market action, the best is, of course, hedge at level 1, but this is too wide, far too wide. So it's best, of course, to have your hedge below level 3. You need to have the hedge always below 50%. So if level 3 here is 81, you can just take it to 80. That is it. 38.2%. So entry at 81.20, hedge is at 80.90, I believe is also possible, or 80.80 is 40 points, 80.90 is 30 points. Whenever a hedge gets opened, you just take profit 5 points below. And we always want to have 2 entries, or divide our size into 2. One entry up front, right up at using a buy stop just above the market level, usually by 3 points. And the second entry is a buy limit. It must be at the support or the resistance. Resistance now is resistance 2, 81.10. So we take it at 81.10. This is the buy limit, and we take profit at 81.20. The buy stop, of course, used to be at 81.20. We take it to 81.30. And then we carry on all the way to 81.60. Always trading in between the internal pivot levels. Right now, the market is trading between 81.10 and 81.30. 81.40, I'm sorry. 20 points. 81.40 is here and 81.10 is here. This is right now our trade. For position trades, the market was a buy. We are going to 82, and we were going to have a hedge at, I believe we have to take this 80.70 or 80.80 is also possible. So we'll just have it to 80.80. It was at 80.80. 80.80 appears to be just at level 3. All right, so for position trades, the market is a buy. We hedge at 80.8. 0.80. 0.80 and 0.8080. 80.80 is this point here. That's where we would have our hedge. And we're going to attempt to carry it to 82. The hedge is very important. If you find that the market is decreasing, we sense that there could be a bit of a retraction. We will fill our buy limit so that we have a full size. If our econometrics is to be correct, then it's very important to calculate how much negative PL we're going to be carrying before we open the hedge. So if the hedge is at 0.38, the hedge is at 80.80, like we were saying earlier. Over here, 0.8082. And the average entry becomes 81.10 plus 81.20. It's 81.15. We're looking at 35 points of risk. By 1.5 standards, you are looking at something like $500 of risk. All right. So if I'm using another 1.5 standard and I take 5-point profit, I'm doing something like $250. That's all. You must, we call this econometric calculation. We have to take very strong note of it so that we do not have uncomfortable or we do not have high running negative PL, and that we can manage the trade in a systematic and comfortable manner. All right, so this is very important. This is actually the most important aspect in short-term trading, because you can make money on the downside just like we're making money on the upside, just in smaller size, because we are counter trend. So to the downside here at 0.8080, we take it to 0.8075. It's just 7 points. Close out. It's always half size of this of the trending entries or the breakout entries. But yet they make money. So if we are doing 1.5 standards, 1.5 standards, I believe we did the wrong calculation. 1.5 standards multiplied by 10 is $150. Half size will be $75. I'm sorry. Half size will be $75. Full size, if we have 1.5 standards, of course, if we are taking 10 points, we are still going to be doing slightly higher than $150, probably $165 per position. All right, in between the risk itself, if we are averaging 81.15 and we're going to hedge at 80, all right, so this is 35 points multiplied by 1.5 standard, and it's a 1.5 standard. 35 points is close to $500. All right, it's a fixed risk system, close to $500. If you're making $165 against $500, it's of course an inverted risk reward, 1 to 3 or 3 to 1, 3 risk against 1 reward. If I raise my hedge entry at 0.8095, I'll bring it to 2 to 1, but I will have more frequent hedges, meaning the market will open to the downside. I'll make money to the downside. If I'm not a very proficient trader, I will not be able to handle the situation, and it might make me nervous, all right, and of course affect my profitability. So it's best that we keep it at this point at a fixed risk system. What is a fixed risk system? It's a system whereby you're going to risk $500 net per day or per week or per half week, related to the time that you're trading. So as an intraday trader, I will trade 3 days a week. I will risk only $500 per day. If I cannot get out of my loss, if I make this way, I can always get out of my loss. Using this strategy, really, I can always get out of my loss. If for any reason the market does a slide to the downside, there is something that is out of my control, and I cannot get out of my loss, then I will only lose $500 per week. Again, a fixed risk system is tied to the period of trading. If I will evaluate or measure my income accumulation over a weekly basis, say I expect to make $1,000 per week, $1,500 per week, and I fix my net negative PL, or I fix my net loss at $500 or $700, say, then my risk reward is still the same, 1 to 2, because I'm risking $700, making $1,500 over a 3-day period or over the weekly period, or maybe $1,200. It's always 1.5 to 1 and 2. So this is important to point out because it does evaluate how to calculate risk. Many traders I know, they just look at risk as where are you going to put your stop loss and how much are you going to risk, and is it a 1 to 3, meaning you're going to win 3 against lose 1. This is very classic, I believe also a bit outdated, and if we work that way, we're never going to make any trade profitable, or you're never going to hit target, because if you're going to risk 1 and gain profit 3, or risk 1 and profit more than 1.5, really, the market will never get you there. All right, so I hope we have covered it. It seems now to be moving higher.